All right, so in this video, I'm gonna be covering exactly what a 2-1 buy down is, who I think it is for, some pros and cons and exactly how it works, plus a lot more. All right, so let's just address the elephant in the room. Mortgage rates are high right now, and so are the prices of homes. So what can you do to make buying a home a little bit more affordable? The thing that most people immediately jump to is putting more cash down, but honestly, it doesn't move the needle all that much. Whether you're putting more money down or asking it off the price of the home, every $10,000 is really only gonna save you about $60 a month. So if you're watching this video right now, you're probably wondering, is there any way that I can still save money on a mortgage while rates and prices of homes are high? And the short answer to that is yes, there is. Probably the number one tool that I'm seeing most home buyers using right now in order to save money on their home loan is something called a temporary buy down. So far this year, I've used this strategy with literally so many home buyers, and it saved them a ton of money on their monthly payments. In fact, the average homeowner stands to save thousands of dollars in the first year of their mortgage alone using a 2-1 buy down. All right, so if you're watching this video and you're new to the channel, my name's Keaton. I'm a loan officer from San Diego, California. And on this channel, I help people just like you learn how to buy their first home and make the mortgage process a lot easier. Full disclosure, this doesn't necessarily solve the affordability crisis that we're dealing with right now. The fact of the matter is rates and home prices are pretty expensive right now, so it does make it quite a bit harder than it has been in a while to buy a home. But if you're still trying to buy a home and can afford it, this can definitely help ease into the pain of buying a home, especially with these high interest rates while we wait for them to cool off. All right, so for starters, let's start with what exactly a temporary or a 2-1 buy down is. As the name implies, this is a temporary buy down of your interest rate. Traditionally, when you buy down an interest rate, you're buying down the interest rate for the life of the loan. The problem with that is if you're going to end up refinancing within the first few years, you're actually losing more money than you're saving. So for example, with the traditional way of buying down your interest rate, let's say you spent about $6,000 in points to buy down your interest rate and save yourself $200 a month. Sounds like a pretty good deal, right? But if you end up refinancing that mortgage after just 12 months, you've only really saved yourself about $2,400. So you've actually lost more money than you've gained. And that's exactly why the temporary buy down strategy is so popular, because number one, it's not your money that you're spending, and two, you're maximizing the savings in those first 2 years if and when you decide to refinance. So unlike a permanent buy down, a temporary buy down only buys down your rate for a set period of time. In the case of the 2-1 buy down, it's lower by 2% in your first year and 1% in your second year and goes back to normal from there. This is especially popular right now because interest rates are projected to go down as low as 4.5% by the end of next year. And with rates as high as 7% right now, you're looking at a massive savings if you're able to lock in a 2% lower interest rate right now and then refinance just 12 months later. All right, so now that you know what a 2-1 buy down is, how exactly does it work? Well, the first biggest piece of the 2-1 buy down is that it relies on what's called a buy down subsidy fee. Now, all that is just a fancy word for a subsidy or a separate account that's set up that helps subsidize or pay for your savings in the first 2 years. So in reality, you're not actually getting a rate necessarily that's 2% lower in your first year, but rather you're getting a payment that's equivalent to it. Here's an example of what I mean. Let's take a look at a $600,000 home with 5% down. And let's use a rate of about 6.75%. On that loan, your principal and interest payment would be right around $3,600 a month. Now, if we drop that interest rate by 2%, getting us to that 4.75 instead, that would give us a principal and interest payment just a little over $2,900. So you can see how that could be really powerful for a home buyer because that's a savings of over $700 a month. And then if you move over into year two, move it up to 5.75%, that payment is roughly $3,300 a month. So still savings about $360 a month there too. So if you add the savings up for those first 24 months, that means you're going to be saving just a little under $13,000. And that's exactly how much that buy down subsidy fee is going to cost. Okay, but then who pays for the buy down subsidy fee? Well, that's what's important, and that's what makes this so unique. The 2-1 buy down strategy actually relies on it being paid by either the seller of the home or the lender or some sort of combination of two. Because this money is essentially subsidizing your lower monthly payment, obviously it wouldn't be something that you would pay for because you're just paying money in advance of what you would have paid in the future. Doesn't really make a lot of sense, I know. And high interest rates are one of the biggest reasons why we're seeing a big rise in the popularity of the 2-1 buy down. This program has been around for a very long time, decades even, but it's becoming more popular because sellers are willing to cooperate with buyers in order to help them subsidize their lower rates. Now, as the case with pretty much every kind of mortgage strategy, there are pros and cons and people who I think that should be using this and people who should definitely not. Starting with the pros, the most obvious one is probably just being able to start with a really low monthly payment on your mortgage. As we used in the example, it's a $700 a month savings in just your first year alone. One of the big things with mortgage payments is that it's interest front loaded, so being able to save that extra $700 that would effectively be going to interest is a huge win for most home buyers. Another big pro is it's just a really good use of the money in general. Going back to that same example on a $600,000 purchase price, if instead of getting that money for a temporary or even a permanent buy down and it was just $13,000 off the price, it would really only save you just a little under $80 a month. Now, that's not to say that $80 a month isn't a good amount of savings. I mean, it's $80 a month versus $700 a month. I think you know which one you would pick. And even comparing it to a traditional buy down, let's say you bought that rate down from 6.75 all the way down to 6%, that's 0.75%. You're gonna get some good savings there. It'll be about $389 a month. And if you're a little bit more risk averse, I think that would be the option that I would take, honestly. But if you're willing to play the game and bet that rates are gonna fall within the next couple of years, the 2-1 buy down is gonna save you a lot more money in those 2 years because you're gonna see a further return on investment doing it the traditional way. Another big pro with this is that it's seller paid. This is money that the seller is paying for, not you as the home buyer. Now, this is very market dependent, but right now in a really, kind of slow real estate market, sellers are willing to cooperate and pay for these 2-1 buy downs in majority of the purchase contracts that I've seen. So it's one of those situations, if you can do it, might as well. But I think the biggest pro overall that actually surprisingly not a lot of people are talking about when they talk about a 2-1 buy downs is it's partially refundable, and that's a really big deal. So let's back up a little bit. Remember how I mentioned that the 2-1 buy down relies on a buy down subsidy account. And every month that you're making a mortgage payment, part of that money is being taken out of the buy down subsidy account to essentially pay the mortgage lender for that difference in the payment. All right, so stay with me here. Let's say that mortgage rates do end up falling in the next 12 months. Well, what happens then to that buy down subsidy account? The good news is that money doesn't just vanish into thin air. It actually gets refunded to you in the form of a principal reduction. And this is an important key because as just with buying a home, refinancing isn't free either. There's closing costs attached to that. But the good news is when you refinance, the closing costs are usually financed into your loan amount. And once you refinance, the remaining balance in your buy down subsidy account is actually refunded against your new principal balance. So let's back up once again to that example. Let's say you bought your $600,000 home, 5% down, and you refinanced after 12 months. Well, you'll still have just a little over $4,300 left in your buy down subsidy account. So let's say the refinance cost you about $6,000 in closing costs, but you got the $4,300 out of that buy down subsidy to kind of help offset that and actually technically reduce the overall cost of your refinance. Now, at this point in the video, I've probably covered a lot of information for you. So if you've got any comments or questions, leave them in the comment section down below. I'll be happy to hop in and answer any questions that you have about the 2-1 buy down strategy or any other mortgage related questions that you got. All right, so for all the pros that there are with the 2-1 buy down, there's obviously some cons as well. And the biggest one, of course, is that it is a temporary buy down of your interest rate, not a permanent one. I've done the numbers on this a few different times, and pretty much what I've found is that a permanent buy down is going to benefit you if you keep the loan for more than about 4.5 years. Otherwise, a 2-1 buy down is actually going to save you more money because it's more front loaded with that savings. So if you're somebody who's a little bit more risk averse, you don't like the idea of that payment going up, you just want to know exactly what your payment is, then yeah, for sure, go with the regular buy down option. It's going to be a lot safer for your budget overall. Or if you really don't think that rates are going to fall within the next couple of years, then yeah, the normal buy down way is going to be a lot better for you than the 2-1 buy down. But for pretty much everyone else, if and when rates do end up falling in the next 2 years, the 2-1 buy down is going to make perfect sense for you. Now, another thing I mentioned at the beginning of this video is that this really doesn't solve the affordability issues when it comes to buying a home right now. And the reason why is you don't qualify on the starting rate of this loan, you qualify on the end rate, or today's rates rather. So just because you're saving that extra $700 a month in your mortgage payment on your first few years, that doesn't magically increase your buying power at all. All this does, it just makes it a little bit easier for you to afford your payments in the first few years while you wait and see what mortgage rates end up doing. So typically, I'm not really recommending this program for anyone who can't really afford or stomach that payment on the other side of it. It's great that you can save a lot of money in those first few years, but if you can't see yourself making that full payment at the third year, don't do a 2-1 buy down. Especially because the idea of refinancing is not guaranteed. Sure, rates might go down, but that doesn't necessarily mean you can refinance. For example, if you lose your job and you don't have any income to show, you might not be able to refinance at all, even if rates are lower. And probably the last con of this is that, once again, this has to be paid by either the lender or the seller, typically the seller. And if you can't come to terms with the seller to get them to agree to pay for the buy down subsidy, well, then you're out of luck. Overall, the 2-1 buy down strategy is pretty polarizing. There's a lot of people who really like it, a lot of people hate it, and there's people who, like me, are kind of in between. At the end of it all, it should be you that decides whether or not this strategy makes sense for you and your finances. So if your loan officer comes to you with the idea of a 2-1 buy down, or you're thinking of it, don't just fall in love with that first year's payment. Make sure you're also in love with that last payment too, because there is a possibility you could be stuck with it. Now, granted, if rates never come back down and rates are at 8% and you're looking at a 6.5%, are you really going to complain that much once you're in your home? Maybe not. But it is a payment that you're at least going to have to be able to stomach and realize it might be waiting for you on the other side. That being said, if rates do end up falling in the next year, I think it's going to be a great win for a lot of home buyers to save that money now while they wait for that refinance. Now, if you're somebody who's thinking about buying a home in the next year, make sure you watch this video next, where I share some of my best tips and tricks that'll actually help you get your finances ready and get pre-approved for that home loan. And if you happen to live in California, make sure you check out the link in the description below where you can schedule a one-on-one call for me. It's completely free, but I'm gonna help you build out a plan, no matter where you're at, if you wanna buy a home in the next 12 months. But I hope this video brought you a lot of new information, helped you make a better decision about your finances if you're considering a temporary buy down. But that's all I got for this one. I'll see you in this video next.